Hi everyone. Suppose a company has just given you its financial statements. Along with that, you have got hundreds of pages of information, thousands of transactions, multiple financial statement balances, and a deadline to issue an audit opinion. Now, as an auditor, what do you actually do first? Do you immediately start checking invoices? Do you start checking bank transactions? Or do you pick samples from the GL listing? You don't do anything of that. But why? Because before you test anything, you need to understand what you're auditing, who you are auditing, and what audit engagement is actually about. So the first question is, what is an audit engagement? In simple terms, an audit engagement is the complete process through which an independent auditor examines company's financial statements, obtains sufficient and appropriate audit evidences, and ultimately forms an opinion whether the financial statement is free from material misstatements due to fraud or error. So let's understand this with a practical example. Imagine we are auditing a company having a turnover of 200 millions with significant inventory, trade receivables, borrowings, payrolls, and other business operations. Management has prepared the financial statements. Our job as auditor is not to simply check whether the numbers are added up. Our job is to obtain sufficient appropriate audit evidences that allow us to reach a conclusion whether the financial statements are free from material misstatements or not. To do that, we first need to understand the business. An audit starts with understanding the business. Before performing the detailed testing, we need to understand our client. What does the company actually do? How does it generate revenue? Who are its customers? What are its major products or services? What system or processes does it follow? What are the significant financial statement balances? What changes made during the year? Did the company acquire any new business? Did it take any significant new borrowing? Did it enter into new major contract? Are there any unusual or complex transactions? So these are the questions which is very important because we cannot properly design an audit without understanding the environment in which the financial statements were prepared. And this leads to one of the most important principles in auditing. Before deciding what to test, we need to understand what could potentially go wrong. An audit is a journey. I want you to think an audit engagement as a journey rather than collection of individual testing procedures. We start by understanding the engagement and the client. We then understanding the business and its environment. We perform our planning and risk assessment. We identify the area that require greater audit attention. We determine our audit responses. We perform the necessary audit procedures. We obtain and evaluate audit evidences. We investigate exceptions and identify misstatements. We perform our completion procedures and finally reach to the conclusion and issue the audit report. So at a very high level, the audit journey looked like this: understanding, then planning, then risk assessment, then respond, then test, then evaluate, then completion, then reporting. And the 70-day series is going to follow the exact same journey. But why do we need an audit? Let's take one step back. Why does an audit exist? Imagine you are an investor and you are considering investing $10 million in a company. The company tells you we made $50 million as a profit in current year. Would you simply accept this statement without any independent verification? Probably not. You would want some level of confidence that the financial statement have been prepared appropriately and that they are not materially misstated. The same applies to shareholders, lenders, regulators, and other users of the financial statement. An audit provides independent perspective on the financial statement, but there is an important point here. An auditor does not guarantee that every single number in the financial statement is correct. An auditor provides reasonable assurance, not absolute assurance, that the financial statement as a whole are free from material misstatement, whether due to fraud or error. We will explore reasonable assurance in a much more detail later in this series. For now, remember one simple point: the auditor provides independent conclusion based on the audit evidences. Who is responsible for the financial statement? This is another fundamental concept. Management prepares the financial statements. The auditor does not prepare the financial statement and then audit their own work. Management is responsible for preparing the financial statement in accordance with the applicable financial reporting framework. Management is also responsible for maintaining appropriate internal control and providing auditors the information that is required for the audit. The auditor independently evaluates the financial statement and obtains sufficient and appropriate audit evidences to form an audit opinion. So remember it in this way: management prepares, the auditor examines, evaluates, and concludes. This distinction is the fundamental to the audit process. Let's take a practical example. Let's say our client has reported a revenue of £80 million during the year. A common mistake by someone new to the auditing is to think revenue is 80 million, so let's check some invoices. But that's not how we should really think. First, we should need to focus or understand the revenue process. How does the company generate revenue? What are the different revenue streams they have? When does company recognize revenue? What systems are involved? What control exists around revenue? What could cause revenue to be materially misstated? And there is another important point. Are there any unusual transactions close to year end? So these are the things which we have to consider. Once you understand these things, we can determine appropriate audit responses. This is the difference between simply performing audit procedures and actually thinking like an auditor. The mindset of an auditor, and this is probably the most important message I want you to take away from day one. As an auditor, don't just ask, what testing do I need to perform? Ask, why I am performing these procedures, what I'm trying to establish, what risk I'm addressing, what evidences support my conclusion, and if I find an exception, what does this exception really mean? This is where real auditing begins, because an auditor's job is not simply to complete the checklist. An auditor needs to understand the story behind the numbers. What we are going to cover in this 70-part series. Over the next 70 days, we are going to follow an audit engagement from the beginning to end. We will start with an engagement itself, with the initial planning process. Then we will move on to the understanding the business and its environment. From there, we will cover the risk assessment, materiality, fraud risk, significant risk, significant classes of transactions, assertions, and audit scoping. Then we will move on to the audit responses, including control testing, substantive audit procedures, sampling, journal testing, analytical procedures, key financial statement areas, and then finally we move towards audit completion. We will cover subsequent events, going concern, identified and uncorrected misstatements, financial statement disclosure, final analytical procedures, completion procedures, and ultimately the audit opinion and sign off. So these are not going to be 70 random topics. We are going to follow one continuous audit journey. By end of this series, you should be able to understand not just what auditors do, but why they do it and how the different pieces of audit work connect together. The key takeaway. So if you remember just one thing from today's episode, just remember that an audit is not simply about checking numbers. It is a structured process of understanding the business, identifying where material misstatement could occur, obtaining appropriate audit evidences, and basis on that, reaching to the independent conclusion on the financial statements. Therefore, don't start your audit thinking, what should I test? Start with what I am auditing, what could go wrong, what evidences do I need to obtain to reach to the conclusion. Once you start thinking this way, you stop looking at audit as a checklist, you start looking as an engagement. And this is the mindset we are going to build throughout the entire 70-part series. That's it for this video. Thank you so much. I'll catch you in the next video.